all of the relief it can give to the impacted sectors. But then what should be your strategy for the longer term? To talk on the same, we have Mr. V. Srivatsa, Executive Vice President and Fund Manager, Equity and at UTIMC. Mr. Srivatsa, good afternoon. Mansi Dave this side. Thank you for giving your time to ET Now. It's a pleasure talking to you this afternoon. Global uncertainties are many, but at the same time, how do you see the picture of domestic markets for the next, let's say, 12 to 18 months?
Yeah, hi. Thanks, Mansi, for giving me this opportunity. Yes, today I think the global uncertainty has risen manifold. I think one is obviously, there are questions on whether the US growth will get impacted and how the global rates will move. But more specifically, I think after a long time, there is a direct impact on India because of the tariffs. So it's a wait and watch to see whether at least the 25% extra tariffs can be removed. Because if the status quo continues, say for the next 6 months to 1 year, that can have some kind of a collateral damage. Obviously, the sectors which gets impacted are direct ones like gems and jewelry and textiles, which may not be significant in terms of the listed equity, but the collateral damage can be big for the whole ecosystem. So we need to wait and watch out for. But I think in terms of the direction of the market, I feel that at least the domestic consumption part has bottomed out, given the initiatives the government is taking to kind of rationalize the GST, and also the benefit of probably the lower tax rates which they did in the last budget. That would, one would start seeing the impact of that in the coming quarters. So definitely, from a I would say from an incremental aspect, I think the domestic demand is looking better than what it was a year back. The markets have corrected in the last 1 year. In fact, India has been amongst the worst performing market. It's a factor of both, I would say, a high starting valuation last year and some level of earnings cut, and plus the global volatility, what we have seen in the last couple of quarters. So overall, I think bearing for any kind of unforeseen events on the global side, I think we really need to watch out for on the tariff part. If that continues beyond a couple of quarters, I think that would be a big risk on India.
All right, so tariffs is going to be a big risk. Hi, Ankur, this side. I want to understand with you now, what should investors do in this scenario? Because tariffs uncertainty is likely to be longer till the time a formal resolution is reached out by both the governments. Looking at this scenario, one should park their money in market or not, or should sit with cash?
Well, I think today, I would say while the valuations have not corrected meaningfully, but they are probably in the fair value zone, and India will continue to attract global flows, more global flows, as well as, there's very strong retail flows. So I do not see a case for any kind of meaningful correction happening out here. One can start accumulating, or one can, start investing, or maybe look at more on the hybrid type of products, which is kind of, a mix of debt and equity. But I would not call a case for sitting on cash or reducing equity at the current juncture, given the fact that while valuations, as I said, it's not expensive, but it's not cheap either. But yes, there are triggers in terms of the market going up if there is some finality on the tariff, because the one end on the domestic part, I think things are looking much better than what it was maybe a year back.
So the expert advice is one can start accumulating, but yes, after proper research. So then, Mr. Srivatsa, what are the winning themes for investors according to you? What are the sectors one should keep on the radar, and also the sectors one should stay away from?
Yeah, I would say one is automobile. I think the sector has seen pressure across the two-wheeler passenger cars and CVs in the last 1 year. With the government push towards the GST reforms, I think this sector will kind of benefit, and the valuations are also quite reasonable in the sector versus the longer-term averages. So that will be one sector, one that investors can keep on hold. The other contrarian bet that I have is IT. I think there the valuations have come off in the last 1 year. In fact, if you look at the large cap IT companies, they are actually trading at a 4 to 6% free cash flow yields, which are very attractive levels to get into. So large cap IT is something that, I would look out for, and especially if there is a volatility or one gets a lower price points because of the volatility, I think that's something where valuations are clearly in favor. Now, while I'm quite positive on the consumption side of some improvement on the consumption side, but most of the consumption oriented sectors, the valuations have not corrected over the last 3 years, in spite of very tepid earnings growth in the last 3 4 years. So FMCG is something one can wait and watch, but I think there has to be some minor correction in the valuations before one takes a call. But auto and IT are the two sectors I would really watch out for. One is triggers in terms of growth, and the second one is pure evaluation led call, where I think being a sector which is very high on free cash flows and ROC, I think the valuations have come off meaningfully in the last couple of years.
All right, Mr.